U.S. banks have been on shaky ground since the beginning of this year. There's been a drastic decline in lending growth ever since the SVB bank collapse at the beginning of the year. Year over year, commercial lending is down 50%. Furthermore, banks are sitting on a mountain of unrealized losses on investment securities, and reports show it to be north of $600 billion, which means that these securities that they don't necessarily have to take the loss on right now are sitting on their books as paper losses. So just imagine you purchased a stock for, let's say, $50, and a month later, that stock price decreases to $25. You don't actually realize that loss until you sell the stock. Most of these securities are fixed-term treasuries, and according to reports, some of these are matured, which means they can sell them, and others have yet to meet their maturity date. Nonetheless, they are losses that are sitting on their books, and at some point the banks are going to have to address these. So ever since SVB and other banks collapsed at the beginning of the year, you have a mound of unrealized losses on the bank's books, you have lower loan origination, topped with the fact that there's higher interest rates. It's hard to see how this could play out without any more bank failures in the future. And I touched on some firsthand experience of how banks and borrowers could be in trouble in one of my previous videos. I actually experienced a bank calling my loan due earlier this year.
Pay up, sucker!
I didn't get into great detail in the previous video, but what essentially happened is I had a yearly revolving line of credit on a commercial loan that came up for renewal. I basically tapped into the equity of an apartment complex that I own, and I put it on a revolving line of credit. I would use this line of credit for flips or any kind of projects or capital expenditures that I may have on any of my properties. Well, that line of credit came due in April of this year, and at the time I had $168,000 drawn on this line of credit. The revolving line of credit was on a 4.5% interest rate, and at the time it came due, the bank offered to either renew this line of credit or turn it into a fixed-term loan, with the only caveat being the new interest rate would be a whopping 9.25%. The bank at the time was kind enough to give me 2 months to decide, so they basically extended my maturity date 2 months and gave me some time to think about what I wanted to do, which was fine because at the time I was semi-confident that I could take this line of credit somewhere else and actually refinance it with another bank for much less than 9.25%, which I don't think was very fair considering I was a long-standing customer with this bank. And at the time, I knew other banks were offering much lower rate. However, I was a bit naive in thinking that other banks would actually take on this line of credit in a second position.
You can't afford to be this naive.
And although it was only a 60% loan to value total with my first position and second position on this loan, no banks were willing to take on this loan. Granted, I only went to 2 other banks. They both declined. So after 2 months had passed, June rolled around, and the originating bank asked me what I wanted to do with this note, and I ultimately decided just to turn it into a fixed-term note. However, it was at that time that the bank notified me that I needed to make a $100,000 deposit into the bank in order for them to proceed with this loan. Aside from the fact that it was extremely unprofessional for them to wait to the last minute to actually notify me that I would need to make this large deposit in the bank, it made absolutely no sense for me to do this considering I only had $168,000 drawn on this line of credit. Why would it make sense for me to put $100,000 in the bank if I only was trying to get a loan for essentially $150,000? It made no sense. On top of that, it makes me a little bit nervous after the bank debacle at the beginning of the year when my bank asks me to deposit such a large amount of money. It starts making me wonder what is actually going on at that bank.
So now I'm suspicious, and I'll order more tests.
Why do they need me, a performing customer, to deposit $100,000 in the bank in order for them to originate a measly $150,000, which, mind you, was already drawn and lent out to the customer? So at the time, I essentially told them no, I was not going to make the deposit in the bank, and they responded with, okay, well, you're going to have to take this loan and get it off of our books. We are not going to renew it. We are not going to renew the line of credit. We're not going to term it out. You need to find a way to get this off of our books. And at that time, the loan had matured and I was in jeopardy of this being sent to foreclosure. Now, this bank is actually a small local credit union, and it was at this moment that I realized that there was something more going on in the economy. If I am doing everything right, taking care of my notes, and I'm still having issues, something is going on. It made me realize that whatever happened at the beginning of the year with those other banks was actually affecting more than just the banks that are reported in the news. Now, from my understanding, they're required to have a certain amount of deposits in order to make and originate a certain amount of loans. Needless to say, I started looking for other banks that would actually take on the first and second position so I could get this off of their books. And even still, I could not find a single bank that would take on my 60% loan value cash flowing property. See, the pickle that I was in here is my first position is on a 4.5% 10-year fixed 25-year amortization loan, which is basically the best kind of terms you're going to get on a commercial real estate loan for a small apartment complex. And it wasn't in my best interest to actually refinance the first position. Of course, my bank was forcing me into taking this loan to another bank. However, no other banks would take this loan, and I ended up sort of playing chicken with my originating bank.
The hard part about playing chicken is knowing when to flinch.
And I kept telling them that no other banks would take this loan. See, I believe that banks don't actually want to foreclose on properties. So I was trying to force them in a position where they had to refinance this loan with me, because I knew that ultimately if I was a performing customer and I was paying my loans, there shouldn't be any reason why they wouldn't just term this debt out. They didn't have to offer me any kind of line of credit. They just simply had to term out this debt on the line of credit that I had already borrowed on. So essentially what happened is they finally agreed to term out this loan and move on. But it wasn't without a whole bunch of heartache and a whole bunch of stress in the meantime. I mean, this debacle went from June until October before it finally resolved itself. See, this whole debacle that I experienced is just an example of how bad a position some of these banks are in and how bad some investors are going to have it. What this made me realize is there are a lot of investors who have debt that is terming out this year and next, and it's not necessarily if they can withstand the decrease in cash flow from the higher interest rates that they're going to have to refinance at when they go from a 4 or 5% to a 7, 8, 9%, just like I had to. It's also a question of whether or not the bank will want to take on those loans. Remember, these banks are sitting on low deposits, they're sitting on a mountain of debt, and they're also quite possibly sitting on bad loans from the commercial office space and other sectors in real estate. And on top of that, whether they want to issue loans or not, higher interest rates means that loan origination is down. So they may not have a choice in the matter. There's just simply going to be less people that are going to be looking for these loans. So all in all, it doesn't seem like it's in their best interest to take on any more risks than they already have. As a matter of fact, the reason that I was in the situation that I was in was because my bank was trying to de-risk their portfolio. See, if they don't have enough deposits to meet their regulatory demand for the amount of loans that they have on the books, they only have two choices. They either increase the deposits or they decrease the amount of loans on their books. They have to balance those two out. And in this case, what they tried with me, neither of those worked. You know, I was lucky in the fact that they didn't actually push this to foreclosure, but imagine all the other people that are going to have to be dealing with this in the future or are currently dealing with this kind of issue. I know I'm only one person in a giant economy, but I essentially did everything right except for having one yearly revolving line of credit. And this one line of credit actually put my whole business in jeopardy because this line of credit was my lifeline for any kind of large capital expenditures. This basically could help me through any kind of tough times. If I had any kind of large expenses, I could put it on this line of credit and pay it down over time. Well, now that line of credit is gone. So when the bank has a choice between their business, even though it was in their best interest for me to succeed, they still had to balance their books. And unfortunately for them, they basically lost a good customer. As soon as rates come down, I'm going to have to take my business somewhere else because it definitely was not a good experience all in all. But imagine all the other people that had FOMO. Imagine these other investors who bought these Airbnb properties expecting to make double what they would if they had a long-term tenant in place. And of course, that's not happening now because Airbnb demand is way down. And now they have to refinance that property at a higher rate. Their cash flow could just get annihilated. Think about these investors that were purchasing properties at a 6 cap on a pro forma, which essentially means that it's not quite at a 6 cap yet. You have to purchase the property, you have to increase rents, or you have to do renovations on these properties in order for that 6 cap to actually come to fruition. And whatever bridge debt they might have had has expired and they go to refinance. And now they have to refinance at an 8%. Well, when you have a property that is at a 6 cap and you're financing it with 8% interest rates, it just doesn't make sense. You're not going to cash flow on that property.
You know, just doesn't make sense to me.
And not only that, these investment properties are based on the income. So if your income is down, the property may not even appraise. Are you going to have to come up with that difference? Are you going to have to come up with the difference between what you owe on the old debt and what the new bank is willing to lend? Banks are tightening their lending practices. Maybe they will only lend on 70% loan to value. So I believe a lot of these properties are going to negative cash flow, and a lot of these investors are going to have to do something. They're going to have to hand the keys back to the bank, or they're going to have to sell at a loss. I have already heard about investors handing keys back to the bank for multifamily properties. I think a lot of investors are going to be underwater, and I think it's going to be happening a lot in the next year. So on top of these banks being on shaky ground, there's going to be a ton of investors that are going to be underwater as well. I mean, imagine a situation similar to mine, but they had to get an appraisal on the property. If you have to take your loan somewhere and originate a new loan with a new bank, you have to get an appraisal on that property. Well, what happens if values drop? What happens if banks are tightening their lending practices, which means they could change their policies from lending on 80% loan to value to 75% loan to value or 70% loan to value? Well, if you had an interest-only loan prior to that because you were trying to stabilize the property and you don't have any of that debt paid down, and you're sitting at 80% loan to value, and the bank that you're with wants you to take that and get it off their books, and you go to a new bank and they say, hey, we'll only give you 70% loan to value on this, are you going to have to come up with that extra 10% in order to keep that property, or are you going to have to sell at a loss and move on? There's absolutely no way that there's not going to be a lot of opportunity with these commercial real estate properties, multifamily, and obviously everyone already knows that office real estate has been hit already and there's opportunities there if you want to get crazy and take any of those opportunities anyways. But my experience with my bank this year showed me that there's more going on in the economy, because if that could happen to little old me, then it's definitely going to be happening to a lot of other investors. I was very conservative with all of my properties. My loan to value on all of my properties is very low. I cash flow well, and I was still having issues. So I think there's a lot that we're yet to see in the economy. So let me know what you think in the comments down below. Let me know if you think there's going to be a lot of opportunities popping up. Let me know if you're sitting on the sidelines waiting. And if you think I provided some value, please smash the like button. And as always, till next time, adios.